Welcome to the J.D. Levy & Associates Calibration Point podcast. Our podcasts are designed to bring a conversational exploration of key topics that we believe will provide value and insight to those serving in the nonprofit sector. We will highlight new developments in the field, latest research, and things we're learning from our own clients that we can share. If there are topics that you would like to see explored, please send them to us through our website at jdlevyassociates.com.
Thank you, everybody, for joining with us today.
We have Mike Hull, who's the CEO of Donaldson Capital. Mike comes to us today with a lot of experience in building companies and as a senior wealth manager and with Donaldson Capital, and a lot of experience in helping people know how to make the most in creating and managing their wealth. And our focus today with Mike is going to be on exploring non-cash giving. Mike, there's some research that just came out a couple months ago that showed that nonprofit organizations in the last 10 years that focused on non-cash actually grew 600% faster than those that focused on cash. And Mike's going to explore this topic with us. And when we say non-cash giving, we're talking about giving other than cash. Those could be stocks, that could be bonds. It could be how I make a required minimum distribution out of my IRA. It could be royalties, alternative currencies, anything that is not cash driven are the things that we are looking at. And Mike, thank you for being with us today. Mike, I think to start us off, maybe we'll just go a different direction. Can you tell us maybe what one of the strangest non-cash gifts are that you've had a client want to make?
Jamie, that's funny you should ask. One of the advisors in our firm this morning blasted out a note to all the other advisors and asked if anyone ever had any experience in donating mineral rights for a piece of property to a charity. And strange as it may seem, one of our advisors did.
Wow.
This advisor's down in Atlanta, and the client, I think, is up in the Dakotas somewhere. And so we're all going to learn something about giving away mineral rights. I assume that's possible, but it's got to have some intricacies to it that I'm not familiar with.
I'm sure you'll find out soon enough.
Yeah. Well, yeah, you covered a lot of the ideas. It doesn't go too much further than what you had in your list. There's some things to know about each of the non-cash gifts that you need to know ahead of time going into it. So I'm happy to cover this in any way that's convenient for you and our listeners, but whatever you'd like me to do.
Yeah, Mike, could you give us, I think one of the challenges we run into the field is that organizations often think that when they hear non-cash giving, typically a knee-jerk reaction is we jump to planned giving. You know, the idea of end-of-life gifts and charitable remainder trusts and everything else. And often we bypass the idea that, okay, so a donor who's going to make $1,000 gift this year may actually have an interest in making a $5,000 gift if they simply thought about making it out of stocks or a bond. I know you deal with a lot of very sophisticated situations. I would anticipate that you also deal with a lot of clients who are making just routine non-cash gifts. Could you help us, just as we think about this topic, understand maybe the nuances and demystify the idea of non-cash giving so that we can connect with it and realize that I don't have to have a formal expert in my organization to be able to have conversations about non-cash giving?
Yeah, I think we could do that. If I get off on something that's too detailed or wrong, pull me back. But you mentioned it first that the thing that we deal with most is appreciated securities, stocks with low cost basis that a client has and they're willing to donate to a charity. And of course, their motivation is that all the capital gain, the difference between the cost what they paid for that stock and what it's worth today, if they sell it, they're going to pay taxes. They're going to pay capital gains taxes on that growth. If they give it away, if they give it to a charity, it hides that capital gain forever, and the deduction is the full amount of the market value of that stock today. There's one caveat, and that is that gain must be long-term in nature, meaning that they would have had to purchase the stock more than 12 months ago.
Okay.
If they give it away, if they just bought it and they give it away in less than 12 months, the tax deduction is only the cost basis, no matter how much that stock has grown in value. But that's an easy one. We set up brokerage accounts all the time for charities who've not done this before, or not-for-profits who've not done this before.
Huh.
And all we do is open an account at one of the big custodians. And so when a client wants to make a gift of stock, they connect us to them, and we say, let me talk to your broker, your advisor, and we will give them the information to transfer this to the nonprofit's brokerage account. It goes in there, and we always suggest that the nonprofit sells it right away. And that's because these stocks move around in price, and we don't want that stock to fall in value. I've seen this happen too many times where somebody gives you the stock, it drops in value, and then the donor feels like you didn't get what they intended you to get. You got less.
Right.
We always say to the non-for-profits, you're not in the investment business, so liquidate this as soon as you can. And I think that would be appropriate for almost every non-cash gift. You should probably turn it to cash for the donor's benefit and the nonprofit's benefit. Just turn it to cash rather quickly, unless it's going into a big endowment. And the same would be true, like I said, for real estate, whether it's income-producing real estate or just raw land. In that case, you have to have a formal appraisal to determine what the market value is. But again, it's a place that the capital gain that would be taxed can be hidden, and there's nothing wrong with deeding over a piece of rental property or raw land. The same can be done with art. It's not a Norman Rockwell poster that you're passing on. It probably should be some, you're looking for people who would have valuable art, who could pass that on to the charity. Jewelry, the same thing, but in both of those cases, you have to have a professional appraisal, which isn't always that expensive. I wouldn't be, if I were the non-for-profit, I'd offer to pay for that appraisal. It's just going to be that much less you get, but it's not going to be that. It's not going to be a big penalty to do that. Personally, I've donated a couple of automobiles to non-for-profits. That's a pretty easy thing to do. In our community, there's a group it's a local, I think it's a body shop, and they take in automobiles all the time, and kind of make sure that they're okay and usable and sellable, and move them on. Those are real obvious things. Jamie, I think there's another place that people overlook quite a bit, and that would be life insurance policies. It's very easy, to name the beneficiary of a life insurance policy. If you have a paid up policy, or even if it's not paid up, to have that named, have the nonprofit named as the beneficiary of a life insurance policy, so that when the donor passes, instead of it coming to their family, if the family doesn't really need it and they've got a heart for the nonprofit, it can go there. If it's a life insurance policy that has cash value, that can be donated. So a lot of options. And then the other one, this is money, but it's not a non-cash gift necessarily, but every IRA, every retirement account has a beneficiary named, and it doesn't have to be a family member that's your beneficiary. Anybody could be named as the beneficiary of a donor's IRA. So you could tag on as a nonprofit can take that as a gift when the person passes on. So a lot of ways to skin this cat, I think.
So Mike, a question about two things you've said that really stick out to me. The first was you mentioned how easy it is for you to be a partner with nonprofit organizations in the field because you're able to just set up a brokerage account, and then it's almost like a plug and play process where a donor says, hey, I would like to make a non-cash gift, and that's already set up, and they can just make that non-cash gift right into an existing brokerage account. That's a really great strategy.
Yeah. Yes, it is. And if I were running a nonprofit, I would make sure that I had a brokerage account somewhere.
Yeah, that's a great point. So I think number one takeaway is every nonprofit organization ought to have a brokerage account set up somewhere.
Absolutely, because you don't want to tell the client, well, wait a minute, I got to figure out how to do this. I said client, I mean donor.
Right.
So, but you know, just you can have the donor say, hey, call Mike Hull, and they'll give you the instructions on how to make this gift, or they'll give your broker the instructions on how to make this gift. And you want it, and naturally, you want it to be as easy on the donor as possible. You want it to be quick and smooth. And if you have that set up ahead of time, you can accomplish those things.
That's a great perspective. Another thing that stuck out to what you said as well, and that is this required minimum distribution. And
yes,
we've seen a lot more activity in the field with the tax law changes last year and increasing the incentives for that. Can you tell us, because I want to complement this with a practice in the field, as a financial and wealth planner, when do you begin having discussions with clients about who they are going to designate as their required minimum distribution payout for the given year?
Clients who have wealthy clients who don't necessarily need the required minimum distribution from their IRAs. So, everybody needs to know that any taxpayer who has an IRA at 70 and a half years old must begin taking distributions from that IRA. The money all went in tax-free originally. So the IRS wants it to look like retirement money, not just leave it in the IRA forever. So they insist that it starts to get paid out. So at 70 and a half, about 3.5% of someone's IRA must be distributed. That percentage goes up every year. And that taxpayer is taxed on that distribution just as if it were salary. It's ordinary income. But under the new tax laws, it's made permanent. It used to be there one year and not be there the next, and now it's permanent as tax laws can be. Anyone who's over 70 and a half and has a required minimum distribution can send that distribution directly to a charity. It's called a qualified charitable distribution, and the limit is $100,000. So, if you had a $3 million IRA, 3.5% of that, might be $100,000. But that's the limit. But that $100,000 can go directly to the charity and never show up on the client's tax return.
Wow.
It's it is an advantage in that if you took that $100,000 from the IRA, it would show up as part of your adjusted gross income. But then if you gave it to a charity, you get a $100,000 deduction for it later. Later being lower in the itemized deductions portion of your tax return. So it is a bit of a wash, except that some states calculate their income taxes based upon adjusted gross income. So if you're in a state that has 3.5% adjusted gross income or state income tax, and it's calculated on adjusted gross income, that $100,000 distribution would never hit your adjusted gross income, and it would save you 3.5% of $100,000. So $3,500, I guess.
Right.
So it's pretty slick. Our clients really seem to like that. They, we work for a lot of wealthy people, and they don't really want to start paying taxes on that IRA distribution. And some people just, they could take it and they could park it somewhere even if they don't spend it. But if they're charitably inclined, and we are blessed with a lot of very charitable clients, and they don't like sending their money to the government, they're tickled to use that for part of their support of their favorite charity, church, whatever it might be.
Right.
It's pretty slick.
I've always heard that you have to make a choice to give your assets to two of three sources, and one is family, one is government, and one is the nonprofit sector, and you have to pick two. And, to your point, I think you're validating that. The other that often happens in the field is that organizations will wait till the end of the year to begin communicating with their donors.
Yes.
Not require minimum distributions that they could make that designate. But from what I understand from your firm and most financial planners is they are actually communicating about those designees early in the year. And so there seems to be quite a miss.
Yes.
And so you see that as well.
Yeah, and maybe that was the question you asked that I didn't answer. At our firm, that required minimum distribution is calculated on the balance of the IRA December 31 of the year before. So, on January 1st each year, every one of our clients knows, or we know, what their required minimum distribution will be. And so we start planning it with them to say, okay, your required minimum distribution is going to be $12,000 this coming year. How will we use that? Will you, are you going to live on it? Do you want us to distribute it to us? Do you want us to give it away? Or do you want us to just move it to another account and you pay the taxes on it? So you're exactly right. It starts in January. We notify all of our clients as to what they need to take out during the year. And every time we meet with them during the year, we track how much more they have to take.
That's a really good point, Mike. And I guess from the field's perspective, then maybe if we are going to use fourth quarter to raise awareness about non-cash giving, and especially around required minimum distributions, then we ought to not be surprised when those gifts actually happen first quarter of the next year when their financial planners are talking with them.
Oh, yeah. Yeah.
It's a great perspective. So number two, I think, is be sure that we're messaging in a way that's congruent with where the donor is within their tax year and in the discussions they're having with financial planners. Mm-hmm. The other thing, Mike, I would like to get your perspective on as well is that when we think about non-cash giving, there was some research that came out a couple of years ago, and they basically said that the majority of donors who had made non-cash gifts, and in some cases even planned gifts, the number one way they heard about that was a simple newsletter from the charitable organization that got them thinking about, I should be having a conversation with this regarding them with my CPA or my financial planner, whatever that might be. And what I hear you talking about that I don't know that we always fully embrace in the nonprofit sector is how much of a partner a wealth management firm can be, because if our charitable organization is successful in meeting the needs of your clients are going to be more successful. And by the way, as a wealth planner, you can really help synergize both sides of that relationship. Would that be accurate?
That is very accurate. And most investment advisors these days they're registered as investment advisors. It's actually called an RIA, registered investment advisor. And with that designation comes a fiduciary duty to do what is best for your client. And that includes advising them on charitable giving. We spend a lot of time. I don't think there's hardly a meeting goes by with a client where we don't talk about charitable giving.
Wow.
And often it's from a tax perspective, but not always. I think so what happens, and I'm going to take this opportunity to stick this in here, Jamie. I think that as an advisor, I need to know the client's entire financial life and beyond. A lot of things. I won't go into details, but our job is to know our client as well as we possibly can, so that when we give them advice, it fits into the whole picture, not just, I'm looking at your money and here's what we're going to do with your money.
Right.
So I think it's important for nonprofits who are trying to raise money to keep that in mind, especially when we're talking about non-cash giving. We have a university nearby here that just received a great big warehouse, and a tower behind it. It wasn't strange. It was just, as the family started looking at what they need, they looked at this warehouse and they said, we're never going to use this. Maybe we just pass it on to the university, and then university ended up using it, actually. But everybody was happy. And I think knowing the whole picture for the family, this sort of gets into often when we start talking about not what to give, but the vehicles to give. Like the difference between a charitable lead trust and a charitable remainder trust really depends upon the family's needs. Do they need the money during their lifetime, or are they they don't need the income. They're more concerned about passing on the assets to their family. You can only know that through getting to know the family and asking some pretty personal questions. But the advisors can help facilitate that discussion, and we very often do.
That's a really good takeaway. So I think, from our discussion on non-cash, I'm really hearing three kind of big points. One is just demystify the whole thing and realize that non-cash giving is accessible to everybody. And you've given great examples, Mike. It could be art. It could be mineral rights, to your point earlier. It could be a warehouse. It could be stocks or bonds or just simple life insurance. And that's really important. So, number one, I think what I'm taking away is let's just demystify the topic and not have it seem so scary. Number two, I love your point about every nonprofit ought to have a brokerage account set up and make this as simple as possible for the people that we care about and share our vision and our values. If we love cats and they love cats, we just want to make it as easy as possible for them to come together with us and get on our boat. Really great perspective. And number three, what I'm hearing you say is really communication and timing of communication. That one, we need to be having simple conversations. That could be something in a newsletter. And number two, when we're doing that, really does have an impact on how that plays out. And I think that reinforces your fourth point, Mike. What I'm hearing you say is partnership. Be sure that we view those within the financial arena as partners, and especially, I did not know the requirement for those licensed planners to be engaging in understanding of philanthropic impact, using my language, and how their clients are going to use those contributions to charitable organizations. It's just a really good perspective, Mike, and I think it's so often in the field, I don't believe that we maximize our partnerships with financial planners, maybe because we're not aware of how to, or maybe we don't, at least I didn't even understand just what you've just identified, that there's an expectation that's placed on them to be a partner with the client. And it makes all the sense in the world that as a nonprofit, we would want to be a partner with you and that you would want us as a partner.
Right. If I could say it another way, I mean, that fiduciary responsibility that we have means we must put our clients' interests ahead of our own.
Right.
And so if a client has charitable inclinations, we've got to recognize that and not try to, I guess I say this to the listeners that are running nonprofits. Most investment advisors are not in a position where they're trying to hold on to the client's assets. The wealthiest generation in the history of man is retiring right now, the baby boomers in the United States. Right. And they've got to do something with this wealth, and we all recognize that. And that's why you see more and more firms like ours who are building specialties around charitable giving and lifetime planning and legacy. It's a real deal. And I think that, any not-for-profit that's trying to raise money doesn't do themselves any favor by ignoring or thinking that they're competing with the investment advisor. That is not the case.
It's a really good perspective, Mike, that we're not in a place of competition. And as we wrap up today, I want to say, one, thank you for being with us, but something else that I'm pulling away from what you've described, and it again, it's the idea, and this seems to be a recurring theme in some of our podcasts, but at least in this arena as well, that the financial planners need the nonprofit sector and the donors need the nonprofit sector. And that's part of civil society in which we all come together because we have a collective common good. And you've definitely reinforced that. And you've allowed me to really think differently as well of, what does partnership look like? Because the nonprofit organization is needed in the field, and it's needed as a partner, not just that we need financial planners as our partner, but the financial planners also need the nonprofit organizations as their partners.
Oh yeah. I mean, I think we should all have the client donor family as our first concern. Yeah.
Really good perspective, Mike. That is our first concern. Mike, again, so thankful that you took time to join us today as we explore non-cash giving. Again, we have Michael with us from Donaldson Capital, and they focus, and his career has been on building and helping to manage wealth and to create impact. And his life is a great example of that. So, Mike, thank you for being with us. And for everybody, thank you for listening.
Thanks for listening to the J.D. Levy & Associates Calibration Point podcast. If you have comments or ideas for future episodes, please reach out using the contact page on our website, jdlevyassociates.com.